Good morning, everyone. I am Bhavna Sharma, Assistant Professor, Department of Commerce, GEMTech Greater Noida. Welcome you to the series lecture of Management Accounting. Today, we are going to discuss the profitability ratios and cash flow statement. In the previous lecture, we have already discussed the profitability ratios based on sales. And today, we are going to discuss the profitability ratios which are related to the investment. So these are the ratios that we are going to discuss in this lecture. Return on assets. It tells us the relationship of the returns or profit with the total assets. So the formula is net profit after taxes divided by total assets into 100. Next is return on capital employed. It measures the overall performance of the company. So this particular ratio tells us that how efficiently the borrowed funds that is being utilized by the management. So the formula to calculate return on capital employed is net profit before interest and tax divided by capital employed into 100. So how to calculate capital employed? There are two formulas for this that I've already discussed in the previous lecture. Return on net worth or return on shareholders funds. This particular ratio tells us the relationship of return with the total funds. So net profit after interest and tax divided by shareholders funds into 100. Shareholders funds means all the funds related to shareholders, that is equity shares, preference shares, any reserve surplus minus any preliminary expenses. Return on equity. This ROE tells us the relationship or tells that how how much is the return is on the equity. So net profit after tax, interest and preference dividend divided by equity shareholders funds. So here we are not talking about the shareholders funds. We are talking only about equity shareholders funds. So here we will not take the preference share capital. We will take only the equity share capital plus reserves and surplus minus any fictitious assets. Next ratio is earning per share. Earning per share indicates the quantum of net profit of the year that would be ranking for dividend for each share of company being held by the equity shareholders. So amount of profits available for shareholders on per share basis is earning per share. So the formula is net profit after tax and preference dividend divided by number of equity shares. Price earning ratio. It indicates the number of times earning per share is covered by its market price. So high ratio means share is overvalued. Low ratio means share is undervalued. So it helps in deciding whether to make investment in equity shares or not. So the formula is market price per equity share divided by earning per share. Dividend payout ratio. Dividend payout ratio reveals to what extent amount of earnings have been paid to shareholders in the form of dividend. So the formula is dividend per equity share divided by earning per share into 100. Dividend yield ratio. It establishes the relationship between dividend and market price of share. So dividend yield ratio formula is dividend per share upon market price per share into 100. Now next we are going to start with the cash flow statements. Cash flow statement shows the inflows and outflows of cash and cash equivalents during a particular period. Cash means cash in hand or cash at bank, while cash equivalents is liquid investments, liquid assets or very short-term assets which are easily convertible into cash. Now, what are the uses of cash flow statement? For cash flow statement, we are able to generate the cash flows. We are able to predict the amount of the cash flows, or what are the timing of cash flows, how much amount would be available during a particular period, say for a month or a quarter. Then it tells us about the ability to meet the commitments. So whether the company is able to pay dividend or loan or interest on time or not. Cash flow statement helps in short-term financial planning. It helps in preparing the cash budgets. It helps in studying the trend of cash receipts and payments, and ascertain the cash flow from various activities. Now, cash flow statement is comprised of three activities. One is cash flow from operating activities. Second is cash flow from investing activities. And third one is cash flow from financing activities. So operating activities will include all those activities which are related to main revenue generating activities of a company, like cash receipts from selling of goods or rendering the services, or from royalty, any fees, commission. And if we talk about payments, then major uh, activities are payment to suppliers or employees. Now coming to cash flows from investing activities. Investing activities, from the name it is clear that all those activities which are related to investment purpose. So transactions that involve purchase and sale of assets like land, building, machinery, plant, which is not held for resale, and other investments like cash payments to purchase fixed asset, or cash received from sale of fixed assets, or interest received, any dividend received, any investment being purchased or sold. And last one is cash from financing activities, like all those activities which result in changes in size and composition of owner's capital and borrowings of the enterprise, like cash receipts from issue of shares or debentures, or taking loans, bonds, cash repayment of amount borrowed, buyback of shares, redemption of debentures, interest paid, dividend to be paid. So all these are the financing activities. So this is the format of cash flow statement, that first we'll write down the heading of cash flows from operating activities, and we will note down all the cash receipts. So generally cash receipts from customers, that is sale of goods, then cash paid to suppliers. Now any inflow we'll write here, and any outflow we will denote with the help of bracket. So bracket denotes the outflow of the cash. So by deducting the cash outflow with inflow, we'll get the cash generated from operating activities. So tax would be deducted, so we'll get the net cash from operating activities. So next we'll prepare second heading, that is cash flow from investing activities. So likewise, if there is purchase of any asset, we'll denote it with the help of bracket. So purchase of fixed asset is the cash outflow. Purchase of investment is cash outflow. Cash inflows is sale of any fixed asset or sale of investments, or any interest received or dividend received. Again, by calculating all these values, we'll get the net cash from investing activity. Next is cash flow from financing activities. So again, issue of share capital is the cash inflow. Issue of loans, the company receives loan. When there is repayment of these loans or shares or any borrowings, then that is a cash outflow. Interest paid, dividend paid is also cash outflow. So again, by calculating all these amounts, we'll get the net cash from financing activity. Now here it would be net increase or decrease in cash and cash equivalents. That means cash from investing activities, financing activities, and operating activities. Here we'll do the total of this. So either it will be increase or decrease. So either the value would be minus or plus. Then we will add the cash and cash equivalents at the beginning of the period, and we will get the cash and cash equivalents at the end of the period. So we can say that Whatever cash and cash equivalents are given in the balance sheet, the difference between the beginning and end would be the net increase or decrease in cash and cash equivalents in cash flow statement. Thank you. That's all for today.